Ladies and gentlemen of the crypto space, we're live on Monday, August 21st at 5:30 p.m. It's busy at the office today, but there's good content to always talk about. I'm sure a bunch of folks want some Q&A. A couple of folks asked me for some Q&A, and maybe I'll start the stream as always with a little bit of words of wisdom as I just show in my selected image pressures everywhere. So I just wanted to state real quick, and then you guys could ask all the questions you want. The system is a set of pressures, and those pressures are either an availability of a capacity to increase capital availability, increase liquidity. It's like decreasing rates increases the potential for a company to get credit, or lenders want to extend credit to borrowers. So if you restrict that capacity to acquire credit and borrow capital, there's a pressure that is holding down the expansion of a financial market. And it's like when a debt is failing to be repaid and it goes into delinquency, that is a destruction of capital. Someone who expects to be paid is not getting repaid, and therefore that asset on the books just evaporates and gets written off. So it's a loss of capital in the system. So you think of the entire system, at least I think of the entire system at this point, in terms of liquidity. And that is very much well described, much better than I ever can, as Mike Howell talks about, and I attempt to verbalize it the best I can. He does it quantitatively, which is something I just found him like more recently than many would think. And his data I find fascinating. The amount of data to gives you a sense of all these pipes that you're looking at, but all these pipes are literally data points that are each individually a pressure on the system, either encouraging expansion or allowing for contraction of available capital to contribute to overall financial liquidity. And velocity of that capital through the system is very much akin to the flow of water through pipes, or the flow of current through a circuit, and being inversely proportional to resistance in an electronic circuit, or friction in pipes, depending on whether it's a small pipe or a big pipe, or you got a bunch of ball joints with valves in the way, is going to either allow flow or restrict flow. So all of this is that kind of story, and we're on the cusp of a variety of very fascinating, I mean, I would say historic deflationary pressures, but are we surprised? Is all throughout history, there's always a series of events that are, whoa, that's the next incredible deflationary pressure right on our doorstep. And that leads us to now trying to assess where we're heading from here. And we're not capital gains traders here. We're trying to get a sense of where the overall pressures in the system will be over the next 5 to 10 years into 2030 is a nice target. And that gives us our path, our destination, and allows us to make choices accordingly. But there's certainly a variety of interesting deflationary pressures on our doorstep, especially as the yield curve continues to bear steepen. It's drying up collateral. And it's not in the short end, so this is the long end, obviously, and it's causing all of these problems throughout the system. It's crowding out credit extension potential, most certainly in the domestic U.S. Who's going to lend to private corporations when you could lend to the government for over 5%, 5.5% on a 2-month bill? Yeah. All right. So, but on the other hand, so that gives you a sense of the short term. On the other hand, I was talking the other day on a Twitter space, I think it was last night, um, that all this fresh on the run paper that the Treasury has issued is all virgin, meaning it hasn't been rehypothecated at all. It's just been brand new print. There's issuance, historic issuance that has matured. So now all this on the run paper gets into circulation, and it has a capacity to finance offshore dollar printing uh, to a great extent. So I think we're in a position where we have a incredible setup for expansion of liquidity conditions, heading into 2025, summer 2024. Has a time frame that sounds palatable to me with regard to where we could see significantly improving liquidity conditions. Obviously, in the shorter time frame in the next quarter between now maybe in 2024, Q1 2024, we could see some very interesting and scary deflationary pressures play out. We'll see then what happens with the central banks around the world and how they want to exercise policy to mute volatility and maintain the solvency of the respective fiscal system. And that's not entirely under the Fed's control. That's a complex relationship between the Fed and the Treasury. But shit, making yields this high on Treasury's issuance is making it complicated from a fiscal perspective. Just the monetary policy that's making the fiscal policy pretty damn complicated. Data para, unusual time, yes. Had a lot of work at the office. Tapsy, wish you a good one. I'll catch you another day. The Hook odds, Cap is drinking for happy hour. I sent a small thread about Aura through Twitter. So Aura changed its emissions. Aura expanded to all of so many chains of late. I have yet to track down or see what protocols are accumulating Aura? What protocols have liquid staked Aura? So you have your locked Aura and it's perma locked in a downstream third party protocol, much like SD Curve or Y Curve or the plethora of a list of LSDs for CRV. So I would like to get a sense of that. Is that there? So obviously internal monetary policy with regard to Aura and its capacity to disrupt circulating supply balancer is meaningful. But what is going to disrupt Aura? You need the downstream protocols, much like Prisma is going to come online and disrupt CVX, and there's the Union, the Pounders from those boys, the Llama boys, and that there's downstream protocols that disrupt CVX circulating supply. So that's what you want to see. You want to see the expansion of those downstream protocols because they come online with their downstream incentive system, and those incentive systems encourage and facilitate basically sterilization of excess CVX and CRV supply. And I would love to see those types of protocols come online to a greater extent that disrupt Aura circulating supply. And when I say disrupt supply, sterilization, that's basically purchasing. That's buy pressure. And so we have to keep an eye out for those. So unto itself, it's very difficult to manage. And we're just going on like comparing one federation to another. And we'll see where this plays out in the next couple years. We know that the downstream sterilizers contribute buy pressure, and that obviously facilitates a more favorable environment, especially when the market is lacking buy pressure. And that is imperative, especially when the overall deflationary pressures in the system get everyone's sentiment scared. They want to liquidate, they want to get out, they sell. So if there's protocols that are deterministically buying, that tends to stabilize these systems that have increasing circulating supply. And that's the relationship, the cyclical relationship that I've been talking about over these years. If you're going to increase supply, hopefully in a disinflationary fashion, you need a mechanism to sterilize excess supply and recycle it back into the system. Thus, the analogy we've been talking about with basically the dollar and the post-1971 dollar, as we've described. Hope that helps. Kill, it's a pleasure. IF, how sustainable long term do you think the voting bribe system on Curve will be? Obviously, is a huge part of the VE Curve investor. Well, that's Z. X, Y, Z. X is an amount of capital that you have. Y is the amount of return you expect to get on that capital on a yearly basis, and Z is what is your speculation for how long that return on capital will last. That's it. It's you are guessing. You are making an educated guess based on assessing the properties of these various systems, this potential significance, PMF, product market fit, of these systems within its local micro environment. And you have to assess the overall significance of these emerging markets in the macro financial system. So I would describe the vast majority of these systems on this relatively micro emerging market of Ethereum mainnet as just barely emergent, maybe even beta testing. This is barely off the ground, and that's why I quite often say what survives this first cycle is quite meaningful. This is the first liquidity cycle of what is very much definable as an emerging market. An emerging market to me is described as something that captures dollars, where dollars get stuck and entrenched in the system that have velocity and they're circulating through the system, performing activity, seeking out opportunity. And that's really what an emerging market is. And that has occurred in this emerging market and these crypto markets broadly, but most specifically the Ethereum mainnet. Dollars have been captured, dollar liabilities, of course. But how long does that last? And what survives? I look forward to the next cycle. I need to be here to see that because post 2020, Q4 2019, there was no money. I wrote a couple of Twitter posts the other day about the market depth, not just the TVL, literally just the liquidity, the stablecoin perspective of how much potential capital flow there was back then. It was millions of dollars, and now there's billions of dollars. The expansion is extraordinary, and that didn't exist. None of this existed pre 2019. This type of market did not exist. It's imperative to highlight to persons that are getting interested in these markets that this is not what people, these are not the markets that people think they are. This isn't tokens and Doge and prices and Pepe and whatever they think it is. This is a financial system that offers credit, prints liabilities, offers money markets, more broadly lending and borrowing, but that credit has an aspect in that conversation. But obviously a CDP that prints dollar liabilities is a little different than like an Aave money market. So there's nuances to these systems. But these systems are components of a more broader financial market. And that's exactly what MeetSpace is. MeetSpace is literally velocity, which is flow of capital, seeking opportunity and buying goods and services, and individual actors seeking out credit to expand enterprise, so on and so forth. So that's why I'm absolutely needing to see what the next cycle is like and how many dollars are captured, because this is not the market that existed in 16 and 17 and earlier liquidity cycles in macroeconomically. This is a brand new market. Hope that helps. How does Japan carry trade work if yen is weakening to the dollar? Well, it's really their rates. If their rates go up too high, the carry trade will be invalidated and investment in Japan will be more opportunistic. And if the carry trade unwinds, there goes long end rates on U.S. Treasuries. That will be a bear steepener. I mean, look what you're looking at on the chart. This white line doesn't really mean much, but we're at 4.45 in the 30-year, 10-year. The structure's broken. Everything's broken. If this breaks out and we hit like 4.5, 4.75, we're in very precarious times with regard to disruption of normalcy to collateral markets, which has the knock-on effect of disruption to currency markets, or maybe it's vice versa. Causality there is a little both ways. But ultimately, Collateral markets are just future currency markets, future currency units, and that all boils down to, demand for natural resources predominantly, and that's oil price. We got to look to oil price. We got to look to dollar FX price. We got to look to collateral market volatility to really understand how some of these pressures are, at least the lenses that I look through, which are not all the lenses like a Mike Howell. I love the move indicator. I love the DXY. It gives me a general perspective on the state of international liquidity conditions. And there's a lot of scary things going on when you look at the bond market and when you look at FX markets. You want to see, obviously, the yen strengthen. This is very high. It's been a hell of a run. And if this continues going in this direction and DXY doesn't hold that 103 line, that magic 103 line that we've been talking about, we have another run. Another run is going to be quite depreciative of foreign fiat, which is going to reduce foreign fiat's purchasing power, which is going to be a significant drain on international liquidity conditions. And what happens when you have less purchasing power and you have less international liquidity? You got to sell whatever the hell you can because you got to buy food and energy and pay your bills. And that's exactly what happens. And that's exactly why the DXY's run up that we saw in 2022 did exactly what it did. And we saw the market sell hand over fist and forced selling. So that's the deal. Sark goes in the house. The hook, you're welcome. With all the volatility, the fundamentals remain for me. Getting the position size right, 2025 time horizon, ensuring I have enough Ethereum, TBTC, and USD as my base, avoiding excess risk. You've nailed it, my friend. Well said. We have a time horizon. We have position sizes. We have There's risk associated with them. We attempt to manage that risk with position size. We have a cash position, the composition of that cash position, as you said, is uh, Ethereum, Bitcoin, TBTC, which is very interesting. It's done quite well. It's a whole story unto itself. And USD, either in a stablecoin form, but I highly encourage bank deposits as well as physical cash. You want to have that kind of diversification as well. But that makes sense as a cash position, and it makes sense to also have exposure to these systems that are speculated to survive, because if they survive and prove to have these significant and relevant financial utilities, they have character. They behave as if they were credit markets and FX markets, and CDPs, Eurodollar markets, Eurodollar banks that print synthetic dollar currency units. Those are very meaningful pieces of systemic infrastructure. And if the frictions continue to decrease with regard to capital flow into and out of this emerging market, it could be very, very interesting. And I want to see that market. So I'm very, as I see numbers go down, great. We have the cash flow. That's the topic we've talked about. How do you, what is our goal, so on and so forth. So I have the cash flow. In the meantime, I see the principal value going down. But I'm excited heading into Q2 2024 on what happens. It's like, yeah, it's going to be crazy up until then, but I want front row seats. I want to be there when things bottom, and you're not going to be able to buy the bottom. So I'm very comfortable and very happy with these positions I have, and they ensure my positioning will be in the front row when things stabilize. And I understand the conditions to look for, and I'll get a sense of when things start to stabilize. You'll see it in the move indicator. Move will come down. You'll see the global collusion in the FX market start to kick in, and you'll see DXY start to come down. Individual currency pairs start to come down depending on, four-letter acronyms that the Fed engages. Uh, with whether it's in response to a strong deflationary impulse or illiquidity in U.S. sovereign debt market, or maybe some sort of contagion effect that propagates from a foreign country, like the collapse of Chinese real estate market, and it bleeds over to whoever around the world holds that debt. some big deflationary pressures, but look at all the collateral that Treasury put out in fiscal 2023. Very interesting setup for 2024. I'm very curious to what plays out in 2024. And all I know is, in conclusion, I got front row seats to that shit. 27 people in the stream, 11 likes. Hit that thumbs up button. I can't believe this many people showed up at 5:40 in the afternoon. But I appreciate it. Tell everyone to subscribe. Can only do better if you hear these kinds of words and talk this kind of conversation. In the description down below is link to Discord, the most rational community in the entire crypto space. I appreciate everyone that has survived in there. Wednesday, next stream. Until then, stay rational. See you next time. Peace.